All right, let's dive in. Today, we're going to talk about something huge, something that trips up so many traders: liquidity. We're going to peel back the layers on what it really is, how it actually moves the market, and most importantly, how you can start seeing the market like the pros do, where liquidity isn't a trap, it's the fuel.
So here's how we're going to break it all down. First, we'll cover why liquidity is the essential fuel for smart money. Then, we're going to pop the hood and look at the market's actual engine room. After that, we'll get to know who's really in the driver's seat, learn how to spot their hunting grounds, and then we'll get into reading the market's terrain. And stick around, because at the end, we'll talk about when that map, well, when it can actually lie to you.
Okay, first things first. Why are we even starting with liquidity? What's the big deal? Well, it's because this concept is pretty much the hidden engine behind almost every single move you see on the chart, and it's the secret to why the pros always seem to be one step ahead.
So let me ask you something. Does this sound familiar? You put your stop loss in what feels like the perfect, safest spot, only to watch the price dive down, tag you out to the exact tick, and then boom, it reverses right back in the direction you knew it was going to go. It is so frustrating, right? And the answer, the reason that happens over and over again, is all about liquidity. And this right here, this idea, completely flips the script. You have to stop thinking of liquidity as just a spot on a chart. It's not a location, it's a resource, it's fuel. Think about it. If a huge fund wants to buy a massive position, they can't just slam the buy button. That would send the price skyrocketing. They need sellers, a lot of sellers. So, where do they find a guaranteed cluster of sell orders? Yep, right where thousands of us retail traders have put our stop-loss orders.
To really get this, we have to pop the hood and go a little deeper. Let's get into the nitty-gritty, the raw mechanics of how a price actually ticks up or down from one moment to the next. It's actually a lot simpler than you think.
Okay, so this is our window into that engine room. It's called the depth of market, or the DOM. What you're seeing here is a live view of all the passive orders, the limit orders, that are just sitting there waiting, above and below the current price. It's literally like a ladder of supply and demand at every single price. Now, this is absolutely key. There are two sides to this coin, two types of orders in this battle. On one side, you've got that passive liquidity, the limit orders we just saw. They just sit there. They do not move the price. But on the other side, you have the aggressors, the market orders. These are the ones that actually make things happen. They attack the DOM, they consume those limit orders, and that is the only way price can ever move. Period. So let's walk through it, step by step. How does price actually go up? It starts when aggressive buyers jump in with market orders. What do those orders do? They eat up all the available sell limit orders at the current price. That's the ask. And once that entire level of sellers is gone, consumed, the price has no choice but to tick up to find the next level of sellers. And this just keeps happening, level by level, as long as those aggressive buyers keep piling in.
Okay, and this is where things get really interesting from a strategy perspective, because not all market environments are created equal. You can have a shallow market, right? Low liquidity, not many orders on the DOM. This means one aggressive trader can push the price really far, really fast. But then you have a deep market, just packed with orders, high liquidity. Here it takes an insane amount of buying or selling just to budge the price.
All right, so we get the mechanics now. We know how price moves. But the next question is, who is actually placing all these orders? Because it's not just one big group. It's a whole ecosystem of different players, and they all have their own goals and, their own special tools.
We've got our basic categories, right? Active orders that move price, passive ones that wait. We've got retail traders and the big institutions. But honestly, the real game, where the smart money operates, is down in those last two rows, hidden and latent liquidity. Hidden liquidity is the big guys trying to hide their true size. Think of passive iceberg orders or dark pool trades that happen off the books. And then there's latent liquidity. This is the big one for us. This is where most of us, without even knowing it, become the fuel.
All right, let's make this super clear with an example. On one side, you have retail Rick. Rick does what seems logical. He puts his stop loss just below an obvious low point. That order is latent. It's just sitting with his broker, totally invisible to the market, until price hits that level. Now, on the other side, you have institutional Ivy. Ivy needs to buy a huge amount, but if she shows her hand, the price will run away from her. So she uses an iceberg order. The market only sees this tiny little buy order, but as soon as it gets filled, poof, it reloads. See the difference? Rick's predictable stop is the fuel for a big move. Ivy's hidden order absorbs a big move without anyone even knowing she's there.
So if retail stops are the fuel,
How do institutions find the gas station? This leads us to the central strategy of smart money. They become hunters. They actively seek out the places where all that retail fuel is concentrated.
And what do we call those places? Liquidity pools. And the key word here is predictable. These aren't random spots. They are massive clusters of those latent stop orders. Think about it. Where does almost everyone put their buy stops? Just a tick above a major high. And sell stops? Just a tick below a major low. These areas become giant glowing targets on the map.
And understanding this helps you see the chart in a totally new way, as two distinct environments. First, you have the liquidity pool. Think of this as deep water. When price gets there, it stalls, it churns, it struggles because there's a massive volume of orders to get through. This is exactly where smart money loves to enter their positions. But then, after that pool is cleared out, you get a liquidity void. This is the open highway. There's very little resistance, and price can travel incredibly fast and far. That's the explosive move you see after the stops get run.
Okay, great. So how do we actually apply this? How can we see this stuff on a real chart? Well, you can start by learning to read the market's terrain. And a big part of that is telling the difference between rough price action and smooth price action. Now, your first instinct might be that a smooth, clean, obvious trend is a strong one, but it's actually kind of the opposite. It's often weaker. See, a smooth move like that doesn't create many little bumps, minor highs and lows along the way. This means there are no small, minor liquidity pools for institutions to tap into. So that supply or demand zone where the move started, it's actually less reliable. Because if price comes back to test it, there's nothing to absorb the pressure until it gets all the way back to the major high or low.
Now contrast that with a rough, choppy, kind of messy-looking chart. That's actually a sign of a much healthier, more robust structure. And here's why. Every single one of those little peaks and valleys builds up a small liquidity pool. These act like little stepping stones or shock absorbers. They make the whole structure stronger, and they give institutions places to enter their positions without needing to cause a massive, structure-breaking move.
All right, but before we finish up, we have to talk about something really important. A reality check. Because this stuff is powerful. It gives you an amazing map of the market. But you have to know, sometimes that map can lie to you. There are other forces at play that you just can't see on a price chart. You know that false breakout that sniped your stop loss? I know it feels personal. It feels like the market is out to get you. But most of the time, it's not an engineered trap. It could just be a simple failed auction. The move broke out, but there just wasn't enough interest to keep it going. Or it could be something way bigger. You could have huge commercial players hedging their physical assets, market makers rebalancing their own inventory, or massive funds adjusting their portfolios. These guys aren't speculating. Their goals are totally different, but their enormous orders are what's moving the price.
And all of this leads to a pretty humbling realization. The price chart you're staring at is an incomplete story. It's fantastic at showing you the effect, the result of all these battles, but it almost never shows you the cause. You see the price, but you don't see the purpose behind that price move.
And if there's one thing you take away from all this, let it be this. So many traders get this wrong. They think the market's main goal is to hunt for liquidity. It's not. That's not the destination. The market is always moving towards what the big players perceive as value. Liquidity is just the road. It's the medium, the path of least resistance it takes to get to that value. It's the how, not the why.
So I'll just leave you with this thought. Now that you can see this map, now that you can spot where the deep pools are and where the open highways are, and you have an idea of who's driving, you have a choice. Can you use this knowledge to navigate more intelligently? Can you start to chart your own course instead of just being the fuel for someone else's journey?